Looking back, today's era looks very similar to the internet bubble. And we have a broad-based stock market correction. The real damage is going to be on some of these speculative names, the SPACs. Those companies are going to have some real problems and have very significant declines, similar to the declines of some of the companies during the internet bubble. Some will go down 75, 80, 90%. Some will actually go to zero. We are calling the inflection point. It is happening now. Value will begin to outperform growth stock on a sustained basis. Rising inflation, which will eventually push up long-term interest rates, will cause the market to revalue high PE stocks, and all those should be coming down in valuation, which is what is occurring today and has been occurring for the past few weeks. I would expect that there's a very real possibility as rates go up that we have a 20 to 30% correction in the S&P 500 and a potentially 30 to 50% correction on the NASDAQ from the highs. We have a large speculative bubble. We have lots of stocks with low revenues that have multi-billion-dollar market capitalizations. I feel very confident that we're probably just past the bubble. The 10 and 30-year Treasury are headed toward the 5% neighborhood. Those interest rates have been what has set the price-earnings ratios for stocks, and the higher the interest rate, the lower the price-earnings ratio. We're looking at a very likely severe recession in Europe, and the question then becomes, does it spill into the United States? I would put the odds at about 50-50 currently. Generally, when a recession occurs, stocks have historically gone down by over 20%, and we probably have another 10 to 15% down to get to the general recession pullback for stocks. The talk now is for a couple of rounds of 50 basis points increases, and there are some Fed governors that are suggesting that we should be more aggressive than that and possibly go at 75 basis points. Quantitative tightening, the reversal of quantitative easing, is scheduled to begin here next week. The Fed has announced that they will start to shrink the balance sheet. Interest rates, in my opinion, will continue to move dramatically higher. If the Fed actually follows through with some liquidity decreases here with quantitative tightening, we could be in for a rough period in the stock market. This is the Federal Reserve, the Fed, has announced it's going to start quantitative tightening next month. What one should note, and even in the face of a no longer growing balance sheet, stocks did run into a difficult period, and stocks could and should probably continue to weaken here, especially if inflation continues to run out of control and interest rates continue to move up. And raising short-term rates, they have started, and they've done a 50 basis point increase. That is the expectations, but the reality is, as long as the Federal Reserve rate is below inflation, the Federal Reserve interest rate is not tightening. It is still loose. So the Fed had promised to start quantitative tightening in earnest in June, and the fact of the matter is the Fed did not reduce the size of its balance sheet at all during the month of June. As the markets rally, I do expect the Fed to continue its program of quantitative tightening, trying to reduce the excess liquidity in the system sloshing around and creating inflation. I would expect the market to experience further weakness as quantitative tightening drags on. So I do think inflation will be a longer term problem and is definitely not transitory. And the 8.5% level is near 40-year highs. So this is a very high level of inflation. All in all, we have entered an unprecedented period in the economy. with quantitative tightening coming after this huge quantitative easing, 800 billion to 8.9 trillion is unprecedented. Bonds generally sell at 2 or 3 points above the inflation rate, or they also sell at nominal GDP. So we could easily argue that the 10 and 30-year Treasury bond, if they're market-based pricing, should be over 5%. So we are officially in a recession. We've had 2 quarters of negative growth. I would anticipate that, yes, although we might be flat for the next couple of quarters, that as this inflationary spiral works its way through the economy, causing consumption to sort of stagnate and interest rates to rise, that will have further negative impacts on the economy. Quantitative tightening is set to double starting tomorrow with the month of September. It will be interesting to see whether the Fed accelerates to that $95 billion a month level. That will tighten financial conditions considerably, and in all likelihood interest rates will head up and the stock market will head down. I would expect it to at least test the lows and possibly break those lows sometime in the fourth quarter. CPI report came out last week. It was hotter than expected. Basically guaranteed that the Fed at its next meeting, which is this week, will raise by at least 75 basis points to the 3 to 3.25 level. The core increased at a 0.6% rate month over month, which doesn't sound like a lot, but annualized that is a 7.2% increase on the core rate annualized.